Hello. So, we- I think there's an echo. If your YouTube is on, Arvinda, just close it.
Sorry? There is no echo from my side. There is no sound from my room.
1 minute. Then my YouTube is on. 1 minute. I'm closing it. Sorry.
Sure. It's fine.
Okay. So, welcome everybody to our series of Empower Her Future. This is a joint initiative by G100 for Financial Empowerment and WICCI Financial Literacy and Management Council. We have started this series because we believe that we want to take financial literacy and financial empowerment to every home through these virtual series. So we just had one session, which was on Saturday, on the importance of financial literacy and financial planning. And we will be going through various other uh, topics, which will include money mindset, which will include investment planning, insurance planning, estate planning. But we decided to have tax planning a little earlier, since this is March and this is the season for tax filing, and maybe all of you women and all of you out there would have a lot of questions. So we had this privilege of having CA Garikipati with us, who is not just a renowned chartered accountant, but she also belongs to our G100 community. And I would like to quickly share a few words about Aravinda and give her introduction. So we will start the session maybe at exactly at 4:10, so that all of you can attend. So those who all are here live, please share in your comments. So let me tell you about Aravinda. Aravinda is a highly accomplished chartered accountant with over 18 years of experience in tax and advisory services. As a fellow member of the ICAI, she made significant contributions to the profession and demonstrated expertise in global tax regulations and anti money laundering regulations. She is committed to responsible business practices and have completed certifications in ESG and sustainability reporting, international taxation, anti-money laundering laws, BRSR, and AI. She is a chartered accountant into income tax advisory and income tax, and member of the Direct Tax Committee and Women Empowerment Committee at FTCCI Hyderabad, and is skilled in policy and decision making roles. With her diverse range of skills and experiences, she is a keen learner and has passion to learn new things as well as write blogs. She is a regular guest speaker at various forums, including Administrative Staff College of India, ASCI, ICAI, CII, IWN, various colleges in Hyderabad, and also been participated as a panelist in DD Yadagiri, Telangana for budget live sessions for 2023 and 2024. So, my dear friends, it's a privilege to have CA Aravinda Garikipati with us. I hope I'm pronouncing your name right,
It's
Aravinda.
fine. I'm not sure. You can
Yeah.
call me
So,
Aravind. That is easy
so
for
I'll call
you.
you Aravinda. Okay. So it's a pleasure to have you, see Aravinda, and I look forward to a lot of learning from you to address all our tax queries. Women have a lot of queries, but somehow at times they feel intimidated to ask anyone, and most of the time they delegate even their tax filing or their financial planning to the male member in the family. That's what we've seen. So we want to break that myth. We want to get education to every doorstep. We want all of them to know the various concepts. We want to make tax as simple as possible, and I thought you would be the best person to empower every woman out there and help us in our vision and mission to reach out and make a meaningful difference in the financial wellness space. So, without taking much time, I think we can start off. So, I will quickly step out, and Aravinda, the floor is yours. floor is yours. I will share the PPT as well.
Thank you, Neetaji, for the wonderful introduction of me, and thank you, Vicky, for giving me the opportunity. So let's start the tax planning. So as the other session, the other day on Saturday is regarding the financial planning, which Neetaji has been taken. So today we are touching upon the important areas which are required for the tax planning for a woman. So this is the agenda for today. We have the session for 4 to 5 o'clock. So the any Q&As will be taken in the last, so that it will be helpful for all the people. So why do we need a planning of finances and taxes? What are the tax saving options? What is the importance of the new regime and the old regime? Which one we need to choose? What is the information required to consider to prepare your tax return? Why do we need to check the form 26 AS, AAS and TIS? Why do we need to pay the advance tax or self-assessment tax? What are the due dates? What is the importance of e-verification? What are the consequences if the e-verification has not been done on time? Capital gains, a glimpse of it. What are the key takeaways and the Q&A? Hope I am audible. So why do we need to do the tax planning
Yes,
for
you
the
are.
tax filings? Yeah, thank you. So to avoid the late filing interest, to avoid the penalties, to avoid the litigation, and to reduce the litigation, to have the better scorecard, to have a better financial planning. I think the screen is, yes, thank you. And to avoid unnecessary stress. Generally, what will happen is people are planning for the taxes. So there is a concept of advance tax which needs to be paid based on the incomes. Unfortunately, they feel that the July 31st is the last date for filing, so I will pay the whatever the tax available as on that date, which needs to be paid by me, will be paid at the last minute, which includes huge penalties and the interest component that can be avoided. So, what are the interest and the penalties which is avoided by you is a part of the tax savings to reduce the litigation. Nowadays, the income tax department has been issuing notices left and right because they are reviewing the information from various sources, which includes your fixed deposits, purchase of properties, your foreign tours, all these things. And unfortunately, the people did not file the tax returns because of various reasons, which leads to litigation. To have a better financial planning, if you file the taxes on time, there is a high chances of having a better financial planning, because you will know what is the amount available with you which can be used for your investments or for any other purposes. And to avoid the stress, the litigation, interest, penalty, all this compounding will leads to stress which can be avoided. So generally, what are the tax saving options available under the new regime and the old regime? The standard deduction is available for the 24-25 financial year is concerned. It is 50,000 rupees. From next year onwards, it will be 75,000, the standard deduction. Professional tax, ATC deductions are, majority of the deductions are available only in the old regime and not in the new regime is concerned. The house, so if you have any deductions which are available to you, and you have the housing loan, medical insurance and all these things, then you can think whether you want to opt for the new regime or old regime. We have the calculator here in the coming slides, which can help you to understand whether you need to opt the old regime or new regime. So HRA component is also available only in the old regime, not in the new regime. So these are the tax slabs as per the new regime and the old regime is concerned, which you generally all be aware of. So the department has, the income tax authorities has making the new tax regime so friendly so that the people will shift it to the new regime. So the possible benefits for the department could be, once you start the new regime, the take home will be more for you, because the deductions which are being deposited or invested by you because of the tax purposes can be used in a different way as per your choice instead of just for the purpose of tax deductions. And the other thing is the clerical work, which includes verification of all the documents for the claims made by us on all the deductions will be reduced because there are no such deductions available under the new tax regime. So when you are planning to prepare your tax return, what are the important information which you need to consider while preparing your tax return? You need to get, when before you plan to visit your tax consultant or a chartered accountant or any other person with whom if you want to do the self-filing for yourself, take out the below documents for yourself, keep it ready. Then you can kickstart your tax filings. The bank statement for the period from April 1st to March 31st. What are the Form 16s issued by your employer, and the Form 16 is issued by the various parties other than the employer, like the interest certificates or any professional income for which 194J, 194C, the TDS has been deducted by the parties for you, needs to be collected. The demat accounts, if any, available where you are involving in the stock dealings, the proof of the deductions which you want to claim if you want to opt for the old regime, the housing loan certificate, the ATC, the insurance, the medical insurance, or the bank receipt, any bank receipts which can help you to substantiate the payments. So if you want to see the ATC or ATCCD and all these things, then you have to ensure that all the documents are in place, and then only you should opt for the same. Just because someone else has assured you a false promise that they will get you a refund or something, don't get into the prey of those things, because the department is very serious in those cases, and you will end up paying huge penalties which can lead up to 200% of the tax liability. Please also ensure that the TDS credit and the TCS credit. TCS credit will apply when you purchase suppose a car or anything. The dealer will deduct the TCS for you, so that the tax credit can be used while paying your taxes. Or when you are sending some money to outside to your daughter or son or to any person, or you have gone for a foreign trip where you have spent amount more than 7 lakhs and the TCS has been credited by you in your account, that can also be used for paying your tax returns. The advance tax paid against the estimates. So what you need to say is, suppose you have estimated your income as some 10 lakh rupees, out of which 8 lakhs is the, I am taking an example only. So it's a, so let's say the example of you have an income of 20 lakh rupees, out of which the salary income is around 15 lakh rupees. The balance 5 lakhs is your FD interest. So you generally, the people will be under the assumption that for the 5 lakh rupees, the TDS will be deducted by the banker, which will be at 10% only. However, you are another 30% slab. If you are under 30% slab, then the balance 20% along with the excess of 4% is to be paid by you in the quarterly installment to avoid the interest, which is an obligation on your part, because it is only 10% which has been deducted by the banker. This type of clarity one should have, so that they can avoid the component of the interest, which is also a saving for you indirectly. Under the new regime, the tax rates has been increased up to 12 lakhs. There is no tax liability for the next coming year is concerned. So earlier, the 87-year rebate is used to be around 25,000 rupees. So it has been increased to 60,000 rupees. Because up to 12 lakhs, there is no tax liability. The standard deduction of 75,000 is available over and above the 12 lakhs. So it is 12.75 lakhs for the salaried cases, where there will not be any tax liability if they opt for the new tax regime in the financial year 25-26. So this is the general benefit which is going to be received by the people for the financial year 25-26 is concerned. Again as the earlier tax slabs, which is the new tax slabs when they opt for the new regime. There is one more concept of marginal relief. So if you see in the newspapers during that time, there was a discussion in the parliament regarding the marginal relief is concerned. So once my tax liability increases by 10,000 rupees or something, do I need to pay the entire 61,000 or only 10,000 rupees? It will be only 10,000 rupees because the balance will be the marginal relief. It will be available up to 12.75 only. Once it crosses the limit, then automatically the entire tax liability actually will come into picture. Why do we need to check the 26 AS, AAS and TAS? Generally, what will happen for the salaried case is concerned, they assume they will be under the impression that the form 16 which was given by the employer is final and they don't have any other income. It's some nominal amount of interest which is appearing in the bank for the savings is concerned. Unfortunately, they will miss the fixed deposit which was lying in their with their PAN number with the bank, or any stock items which was deal with purchase and sale of securities. Generally, what will happen is if there is any loss or something in the securities, the people will be under the impression that since it is a loss, why do we need to disclose? Because once you need to disclose the stock income, securities income, the ITR will change. So generally, why do I need to change the ITR? Let me go with the ITR one itself. If it is only salary income, interest income, then and one house property, it will be the ITR one. Once you have the sale of securities, automatically the ITR 2 will come into picture. The other thing generally what will do is the people will be receiving the ESOPs from the foreign companies. Suppose say it is Infosys, it will be the Indian company. But if you say the Microsoft or Google or some other organization which has the holding company as the US parent company, then the ESOPs will be listed in the US stock exchange or some other stock exchange which is not the Indian stock exchange. So all this information needs to be disclosed in the ITR2 in the foreign assets schedule. Suppose the employee has gone for a short assignment to a US or Japan or Singapore. There he opened a bank account for temporary purposes to meet his expenses to meet his expenses to meet the regular day-to-day expenses over there. However, he might have he might not have a adequate income or adequate sufficient amount lying in the particular bank account. Still, he needs to disclose the same in the Indian ITR because during the financial year, he hold a foreign account which was lying with the foreign tax under the foreign tax authorities area. So what will happen if I don't disclose all this information regarding the foreign assets is concerned? The officer may issue a notice under the Black Money Act, which is for which the penalty can be as heavy as 10 lakh rupees. So it is recommended to disclose all the foreign assets because the foreign asset disclosure does not lead to tax liability. It's just a disclosure purpose. Even the stock income which was held in the foreign account is for the tax purposes will not come into picture as long as you don't sell the same. However, what are the ESOPs is there, which is a perquisite, which is already forming part of your Form 16. So disclosure is more important irrespective of the taxability of the component. The AAS will help you in identifying what is the interest income, what is the purchases, what is the sales, what if you purchased any property or had you sold any property, everything will be crystal clear in the AAS, which will get updated at regular intervals. So it is recommended to verify the AAS and TAS and the 26 AS before filing your return and finalizing your tax liability. And it is also recommended to take a copy of the AAS and TAS and 26 AS, which can help you tomorrow that if something has been updated subsequent to your tax filing, which you are not aware of, or any information which has been disclosed in the AAS which does not relate to you needs to be replied in the portal itself, stating that information is incorrect and does not belong to me, or if you know that the information is related to some other person, and if you know the PAN number also of the other person, then you can disclose the same. And sometimes what will happen is in the AAS, when you purchase a property along with the 3 or 4 persons, the first PAN number might got triggered and other subsequent PAN numbers may not be visible in there. So what will happen? The entire purchase consideration or the sale consideration will get triggered into the PAN of the particular single person. So when the same thing has been popped up in the AAS, you have to reply it back stating that information is partly correct, and you have to disclose the other details of the persons along with whom you have purchased or sold the property, so that the bifurcation can happen and only the exact liability will be determined for you. Why do we need to pay advance tax? As told you earlier, tax saving includes reducing in the tax interest, penalties, and taxes. Generally, the salaried employee will be under the impression that the employer has deducted the entire tax. Why do I need to pay the advance tax? Advance tax is not my cup of tea. It is unfortunately false, because when you have a capital gain, say because of the sale of the stock income, securities or shares, there is you might have end up in getting a capital gains for which you are liable, which needs to be paid on a quarterly basis, because the information will be also captured on a quarterly basis manner, for which you have to pay the advance tax. If there is any house property as property income which was received by you, and the PAN number of the same has been provided by the tenant to their employer, definitely it will form capture in the 26A, sorry, AAS. So the income which was received from under the head income from house property is liable to tax, and you have to pay the advance tax on the same. The other possibility is interest income. As told earlier, that banker will deduct only 10%, the balance 20%, or the what are the slab under which you fall needs to be paid by you as applicable to you. The other thing is, generally there is a short trip which was gone by you outside India, for which you might have received 2 months or 3 months salary outside, which is taxable. Then once you club that foreign income into your Indian income, automatically due to the conversion, it will be a huge amount which will affect your tax liability. The other possibility is you might have changed the employment during the financial year. Unless you inform your HR with the actual pay details, that any amount received by the employee from other than employer, there is a column in the form 16. That information has to be provided by you, so that there will not be any duplication in the standard deductions, any ATC deductions, or any exemptions, because the second employer will be, unless you disclose it, will give the deductions again, which leads to a double deduction. And once you club both the employment income, automatically there will be a huge tax liability, with along with interest you end up paying in the last month of July or something, where it will be very huge and it will hit your bank account badly. And the other thing is, please ensure that the Form 26AS captures the actual tax credit which was deducted by you. Nowadays, you will get the SMS also quarter-wise, where the TDS and the accumulated income is being captured. So ensure that it is considered in place. And also, if you have received any gifts from your people which are not related to your blood relationship, the same will be considered as a part of your other income, for which the tax, if it is more than 50,000 rupees, that will form part of your other income, and the tax liability has to be picked by you as advance tax. So even in that case also, the concept of advance tax come into picture, and you will end up paying the taxes. If you pay the taxes by quarterly, 15th June, September, December, and March 15th. So if you pay it accordingly, there will not be any interest component. In the absence, it will lead to a interest component. So to determine which regime is better and which is best for you, you can check what are the deductions available for you, the actuals. Generally, what will happen is, during the period starting of the year, you will give to the employer the possible deductions which you are going to claim. However, in the absence, if something is being missed out or you are unable to make the payments, then the particular deductions will not be available for you for the claiming of the taxes. This is the income tax calculator, which can help you to determine what is the deductions available to you, so that you can know which regime is better, or what is the tax liability under the old regime and what is the tax liability under the new regime. Can help you in. I will show all the calculator links at the last so that you can see one by one independently. So if there is a change in the tax regime, the same needs to be filed before filing of the original return. That is 31st July 139.1. So Form 10 IEA has to be filed. You cannot change the tax regime for a belated return or a revised return. So please ensure that the forms has been filed before the due date to opt for the same. Next, the other thing which generally what will happen is you might have missed the due dates. Earlier, the due dates will be for filing of the revised return is but more than the current nowadays. So the concept of update return has been introduced by the department, which can help you to proactively file for yourself instead of the department picking up under section 148 by issuing the notices. However, you have to pay the additional tax liability, and the original return can be updated provided there is no refund being claimed or there is no deduction, no reduce in the income. These are the deadlines and the additional tax liabilities which needs to be paid. So the other question what generally will happen asked by the people is, why do I need to pay 25% additional tax? Let me pay the tax. Let me file the tax return once the notice comes. The other thing what will happen is, once the department issues the notice in section 148 and close the assessment, and if they found that there is any misreporting or underreporting, the penalty will be a 50% to 200% of the tax liability. To avoid those penalties, this 25% of additional tax is comparatively lesser. But however, it is always recommended to file the tax returns before the respect to actual due dates to avoid unnecessary litigation and interest and penalties. The other thing generally some of the people will generally do is they will file the taxes on their own and they feel that everything is done, but they will miss the e-verification. Once you miss the e-verification and the deadline is crossed, it will be considered as an invalid return. So the return which was filed without e-verification is as if nothing has been done by you. It will end up paying the penalties and there is no excuse for the same. So once you upload the return, if possible, try to get the e-verification done, e-verify with Aadhaar OTP, which is easy for you, because automatically you can do it same parallelly without a delay in the filing. Unfortunately, if there is any technical glitch in the website, then in the next immediate day or maybe half an hour or 1 hour later, you can try doing the verification, but never dare to skip the e-verification. It leads to a penalties and non considering as a non-filing of the return. There is a video available in the income tax website itself, which can help you to understand how to do the e-verification with the Aadhaar OTP, bank EVCs, and the DSCs. The e-verification has to be done within 30 days from the date of uploading of the return. So, unless you complete the e-verification, the return will not be considered as valid filing. And the other thing is, if there is any discrepancies or any defectiveness in the return, the notice will be issued on section 139.9, where the department authorities will ask you to rectify the defects, which needs to be answered within 15 days. In the absence, the option to upload the documentation will be blocked, which leads to the 143 intimation. Subsequently, either 154 has to be filed or you have to go for an appeal. it starts leading to the litigation. So it is always advisable to act upon the SMS received from the tax authorities immediately instead of waiting for the last minute. And nowadays, as and when you upload a return or anything, the department is sending the SMS and the emails at regular intervals to educating the SSCs and to make aware the SSCs that the due dates are approaching. Sorry. So just want to touch upon the capital gain glimpse. Generally, what will happen is there is a concept of long-term capital gain and short-term capital gain. So long-term capital gain will come into picture when we have when an asset has been held for more than 24 months in the case of the properties or thing, or if it is in the case of securities, it will be 12 months. So for the listed equity shares and equity-oriented mutual funds, long-term capital gains exceeding 1.25 lakhs in a financial year is taxed at 12.5%. In the last year, July 23-24, the budget has been placed before the parliament on July 22nd. During that time, there is the concept of the change in the tax rates, which has been later clarified, stating that the transaction which was made up to July 22nd, what is the tax liability of the long-term capital gain, what is the tax liability subsequent to the July 23rd. So earlier the tax rate used to be 10%. It has been changed to 12.5% from July 23rd to 2024. For real estates, land and unlisted shares. Unlisted shares is to be considered which was not listed in the Indian stock exchange. Even though it is listed outside India, it will be considered as unlisted shares for the Indian tax perspective is concerned. There is a concept of indexation which is available for the long-term capital gains. Generally, say suppose you have purchased a property in the year 2002. The value of the property is say 10 lakh rupees. When you intend to sell in 2024-25 financial year, if it was being sold before July 23rd, what is the tax rate? And after 23rd, what is the tax rate? There is a concept. So the 2001 value needs to be indexed to the current rate. There is a CAA indexation which was given, based on which the indexation will be done. For transfers made on or before July 23rd, 2024, long-term capital gain is taxed at 12.5% without indexation. So suppose the 20 lakhs is concerned, the entire 20 lakhs is taken as intact and the sale consideration minus cost is without indexation. If you take the indexation, then it will be the different tax rate. Tax transfers made on or before July 22nd, 2024 are taxed at 20% with indexation. So if you take the indexation benefit, it will be taxed at 20%. If it is taken without indexation, the benefit is 12.5% tax rate. So you have to calculate both the calculations and see whichever is beneficial to you. Based on that, you have to determine whether you want with indexation or without indexation. What is the cost of improvement? All these things needs to be considered by determining the capital gains. Once you determine the capital gains, the advance tax has to be paid accordingly if the TDS deducted on sale of property was not sufficient for you in your case. So when it comes to the shares is concerned, it is 12 months. Listed equity shares must be held for at least 12 months. Unlisted is for 24 months. Original purchase price from the sale price minus purchase price is the capital gain. Selling equity shares listed on stock exchange with less than 12 months. If it is short term, when the shares has been sold in less than 12 months period for the holding, it will be considered as a short term capital gain. If the sale consideration is more and cost is less, it is a profit. If the sale consideration is less and cost is more, it is a loss, whether it is a long term or short term. For the short term is concerned, the capital gains are taxable at 15% until July 22nd, 2024. It will be 20% from July 23rd, 2024 onwards. So I would like to touch upon the key takeaways which can answer some of your queries, and the Q&A will be taken at the last. So there is no discrimination between the men and women in tax rates in India is concerned. where we are treated on par with the men. The woman needs to file the tax return as long as she has taxable income in India, irrespective of whether working or not. Some people will be under the impression that they might be receiving some stock income and some house property income and interest income. They feel that they are not working, they not file the tax returns. It is not correct. As long as you have the taxable income, you need to file the tax returns in your independent capacity. In US, there is a concept of joint filing for the wife and husband is concerned. There is no such concept of joint filing in India. So everyone is considered as a separate legal person, whether it is a wife or a husband. So it is your responsibility to ensure that your taxes has been paid properly and the return has been filed accordingly when you are receiving the income with your PAN. The filing of the tax returns helps you in getting the loans at a faster rate and for the visa purposes, because generally the income tax acknowledgement copy is being called for to get the loans, even if you want to take the mudra loans or the women loans which are available for your business expansion or for your personal capacity. It actually helps you even for the work visa purposes. Also, you want to go for a vacation or something, or you want to go for some other country to visit your kids or something, it will actually help you. The tax filing helps you to determine the actual income, what is the amount left with you for your investment purposes, and what is the source of expenses. Nowadays, in the last, I think if I'm not wrong, 10 days back or something, a news article has been published which states that the department has asked for the expenses which was spent by a person. So if you file your tax returns, it actually helps you to determine that you have enough income to spend for your expenses. So it is your responsibility to ensure the tax return is filed properly, which can reduce your litigation and have a stress-free life from the tax authorities is concerned. Mahila Samman Savings Certificate Scheme is a small savings scheme backed by the government, which is available for exclusively for the women is concerned. It is also recommended to have the own term insurance and medical insurance for the women for our financial security. Generally, what will happen is the men in the family might have the term insurance. Generally, the woman will not touch the term insurance because मेरे पति के पास है ना, बस चलेगा. That is not the concept. Everyone is independent and every person is a legal person, and it is your financial planning and it is your finances which needs to be taken care, which can help you in the long run. Like this, take as medical insurance is concerned. Generally, what will happen is if you are working as an employee in some other organization, so you will be under the impression that my employer will take care of. Agreed. There may be a notice period or there may be a gap in your employment during which you might not have the medical insurance, and if some unforeseen situation happens, who will pick up the cost? Your entire savings will go for a toss. So irrespective of your employer having a medical insurance or not, it is your own responsibility to take the medical insurance, and the term insurance is to be taken at the very young age once you start your earnings, which can help you to reduce the premium amount, and that coverage will be at a maximum rate. Generally, the impression will be income minus expenses is equal to savings. But let's start. Income minus savings is equal to expenses. The income is fixed. The expenses should be the variable component, which should be after the left out of the savings. Income minus savings is equal to expenses. So these are the tax calculators which I want to show you. Am I able to go live with this? Sorry. Ma'am?
Yeah, sorry, I didn't get your question. You said?
Yeah, so I actually want to open these links. Is it possible for me to open the links?
No, I think this is a PPT, no? So maybe you can
PPT has
try
the
it if
direct
it is
link.
happening. So see if you can do it. No, it's not allowed. So maybe you can present it if it is available on your screen.
Just hold on then. I will do it. Just give me
Yeah.
a minute.
So I think we've had some wonderful insights and in the session. Arvinda is
Are you
just
able to
trying
see
to
the
help.
screen, ma'am?
Yeah, we are able to see the screen.
Perfect. So this is the calculator which is available in the income tax portal
1
itself.
minute.
You can just go to the home page
1 minute. I'm
where
just
you
adding
have
it.
the, yeah, sure.
Yeah. Now you can go.
Yeah, thank you. So if you go to the income tax calculator itself, where you can mention the amount. Okay, this is the husband year 24-25 is concerned. Let's say 25-26 is concerned. Your taxable income is say 30 lakh rupees. Okay. See how beautifully the department has prepared for us. The allowances is say suppose 2 lakh rupees, right? So the net taxable
Hmm.
income, what are the deductions? Allowances and exemption of the old tax deductions. They say suppose 1,50,000 rupees. So here clearly it will be visible what is the tax liability as per the old regime and new regime. What is the benefit? So you can decide for yourself. There is no need for to ask for as anyone else what is my benefit under the old regime and new regime. The only thing you need to know is whether the figures are correct or not for yourself. There are other slides which I can, other things also which I can show you.
Do share the link later on in the comments so that everyone who's
Okay.
watching the recording or would want to go through this can actually go through the links.
Okay, then I will do that. Just hold on.
So this is to decide which regime you should go in for, the new or the old tax regime, which Aravinda is showing
Yes.
us. It's about e-filing. It's the government website, right?
Yes, it's a government website. That's why it's more reliable, right?
Right.
So can I post in the comments the links?
Yeah. I think that
How
would be
does it
better.
look?
We can do that later once the session is done.
Okay, sure. Done. I will share it with you so that you can post it, not an issue.
Yeah. Yeah.
Okay. So get back to the presentation.
1 minute. I'll just do that.
So these are the income tax calculators and this is the HRA calculator. Generally, the people will have the queries regarding the HRA is concerned. How the HRA has been calculated by my employer, whether they have done it correctly or not. This is the link which can help you to check for themselves whether the employer has done correctly or not. If they have any queries, they can reach out to their employer showing the calculations. There is a concept of 44 AD and 44 ADA is a presumptive taxation, which generally will helpful for the women who are under the freelance basis or in a professional capacity, not as an employee. So this 44 AD is for the engineering, accounting, legal, medical. There are such specified provisions which has been given, which can help them actually to opt for this, so that there is no need for them to maintain the books of account and all these obligations. And a fixed percentage has to be offered to tax, which can help them to avoid unnecessary issues and easy maintenance of the things. That's all. So all the links will be provided with 44 AD and ADA links are also been provided here. I will share it across to you so that you can post everything in the website, which are all from the income tax department only, a reliable one, which can help you to do their homework before reaching out to any tax consultant, so that the taxes can be paid on time, because generally people will be under the impression that they don't know how much is the approximate tax liability. That's why they need more time to calculate for themselves and then go to a consultant. So these are the tools available readily with them, which they can do at their own pace, and they can approach the consultant beforehand and they can get it closed before the due dates without any liabilities and penalties, extra liabilities and penalties.
Right. So thank you so much. I think this was really insightful, Aravinda. And as they always say, this what we are trying to do here is not helping you to avoid tax, because tax cannot be avoided. You cannot evade tax, but you have to ensure and see how you can minimize your tax liability. So that is
Yes.
by investing the right way, being aware. And the objective of this session is to empower every woman and also other individuals. As Arvinda rightly said, there are not the major things which are there are not very different when it comes to a man or woman when it comes to tax returns or tax filing. There are certain advantages which women have depending on the sections or I think depending on the slabs which are provided by the government. But otherwise, more or less, it is for everyone that we need to ensure that we not evade tax, but we have to pay tax because that's our way of giving back, and also to the government, where the government uses it for various infrastructure and various other things. But we need to ensure that we minimize our tax liability by investing the right way, and we focus on getting better post tax returns, right?
Be a
So
responsible citizen. We need to pay the taxes correctly, which can help for the developed economy.
absolutely,
2047
absolutely,
Viksit Bharat can be
right.
achieved only if everything contribute a little on their from their part.
Correct, absolutely. So, coming to the other few questions which I had while we were going through this session, and also maybe some of our viewers were having, because some of the team members had posted some questions which I've put together to ask you, Ravinda. Most of them were covered, but I think still there were a few things, like you rightly said, for every woman or every man, I mean, all women, irrespective of her income, she has to file her returns, right? You mentioned in the final key takeaways, because there were questions like, if there is a senior citizen, okay, a woman, maybe in her 75 or 80s, she's not earning anything other than FD interest or maybe some rental income, does she still have to file her returns?
Yes, as long as she has the taxable income is concerned, from the coming year 25-26, it will be under the new regime, it will be 12 lakh rupees. Okay, so
Okay.
if her income is exceeding 12 lakh rupees, then she or he has to pay, definitely file the tax return. Filing of tax return does not mean paying of taxes. Filing of taxes is
Right.
different, paying of taxes is different. There is a thin line of difference
Okay.
between the same.
So if you can just explain that to our viewers, because at times, you have to even file if your returns are zero, right? Even you
Yes,
have to
there
pay
will be
zero
zero
tax, you still
returns which
have
has
to
to
file.
still
So
file
why is
because it
that?
is, yes. So this is, once you cross the basic slab limits, 2.5 lakhs, 3 lakhs, 5 lakhs, what are the tax slab applicable to you based on whether you are a resident or a senior citizen or super senior citizen. You have to file the tax returns, even though it is a nil return.
Right.
Tax
So
liability
you
is
have,
different, filing of tax, because actually once you file the tax return is concerned, once you have the taxable limit, it actually helps you in, as shown in earlier, it will help you to explain your expenses at a later point of time. Suppose you plan to invest in some purchase of property or something, and you have used all your accumulated savings, say about 20 lakh rupees, which was accumulated from the past 5-6 years, which is visible through your tax return filing acknowledgements. The same proof can be used if the
right.
departments in the future year ask for you what is the sources for purchasing property. So I can clearly show these are the incomes which has already been offered for tax. So that is the same amount which has been used for purchase of property. So filing will actually help you
So
for a
as I understand,
better explanation of your expenses.
even if you're 75, sorry, yeah, right. So if I understand that, if an individual, a woman is 75-year-old, and even if she has no income, does she have to file her returns?
If there is no income, that's what, if she don't have the taxable income, then she does not require. If she has a taxable income, then she has
Okay.
to file.
Which also includes FD interest, right?
Yes, FD interest, salary income, income from house property, income from business or profession, interest in income from other sources, capital gains. If any of these heads are
Perfect.
clubbing together exceeds the amount of the taxable component, then definitely they have to file.
Perfect. So there's another question from another team member, Sneha, who asked me regarding minor income. So
The
if there
minor
is a
income will be
child
a
in the
clubbing
family,
income.
yeah,
Yes. Clubbing income
okay.
will be
If you
forming
can
part
just
of the guardian
elaborate a little
income.
further.
So whose PAN number will be given with the banker, the respective person has to pick up the clubbing income. And it's taxable
And the
under the income
tax,
head
it will
from
be
other sources. You have to pay the taxes for it
perfect.
accordingly.
Perfect. So as you also mentioned about investments, because we are into financial planning and financially empowering our clients, you spoke about long-term capital gains and short-term capital gains. So for our viewers to understand, because there are a lot of women who want to understand the basics, long-term capital gains is when you are selling an asset, and the gain, that is the profit, on that there is a tax. So long-term capital gain tax, as you mentioned, for is around the rate of the rate is what you said, 15%, right?
12.5% and 20% will be there. 15%
12
is for the short-term capital gain.
short term
So
capital gains.
generally, an
Perfect.
asset will be considered as a long-term or short-term based on the holding period. When it is an immovable property, it will be 24 months. And when it is a mobile property, generally the sale of securities or share, it will be 12 months is concerned. So when you intend to sell a property and say, suppose you
Okay.
have a
Wonderful.
flat which was sold by you during the financial year, and you have considered to opt not to have the indexation concept. So without indexation, it will be 12.5% when it was sold subsequent to July 23rd, 2024. So the capital gain, sale consideration minus cost is the capital gain. If you want to pay the taxes flat 12.5, you have to pay the taxes.
Perfect.
If you don't want to pay the taxes, there is a options of 54 exemptions. Section 54 will be the section under which the exemptions are available, under which exemption you can claim or needs to be read thoroughly and understood, and the investment has to be done accordingly. Suppose if you don't want to if you don't have made up your mind, there is a concept of capital gain account scheme with the bankers, where which you can deposit before the return filing is concerned, which can be used subsequently, but only for the specific purpose for which it has been deposited. And the assessing officer has to give the permission to withdraw the amount to the banker. So you should be careful when you are depositing the same. So please make up your mind before starting investing somewhere.
Wonderful. And I think one final question which was also put up was, how does gift tax apply when a woman receives money or assets from family members?
So the gift is regarding the gifts is concerned. Generally, if it is from the blood relationship, there is no gift tax. However, if you receive it from your friends or from other persons who are not related to the blood relation, then and the amount exceeds 50,000 rupees, it will be taxable under the head income from other sources, and you have to pay the advance tax accordingly. Gift आपको लेना पड़ेगा और tax भी भरना पड़ेगा.
Wonderful.
You have to do
And
both sides.
again, one last question when it comes to GST and tax filing, when it comes to women who are entering into entrepreneurship. So some of them had this query that women who are getting into entrepreneurship, when should they apply for a GST for their company, and what should they be aware of the tax, when they are getting into entrepreneurship?
Regarding the GST is concerned, the respective states have the amount threshold limits. Say if it is in Telangana, it will be 20 lakh rupees. Some other states might have been 30 lakhs as a threshold limit. So as long as your gross receipts does not touch that limit, there is no obligation for you to have the GST number. However, you can take it voluntarily because there will be many organizations which will be interested to have a transaction with you only if you have the GST number. Suppose if you want to sell some of the items in Amazon or the Flipkart or something, generally the people will ask you for the GST number for registration to get into the portal. So where you will take the
Right.
GST number voluntarily, even though you don't have the threshold limit. But once you take the GST number, you should ensure for the nil filing so that the GST number will not be taken back by the department. It will be cancelled otherwise. Non-filing will lead to penalties also. So you
Wonderful.
should ensure the compliance is one of the important area which needs to be taken care in all areas, whether it is GST or income tax or the ROC is concerned. Everything the compliance plays a crucial role, and nowadays the non-compliance is having very huge penalties, which will end up closing the businesses also.
Wonderful.
And once you are compliant to the procedures and legal issues, it will be easy for you to get the funding from the angel investors or from the VCs, because they
Right.
will definitely look into the compliances, because that shows how serious are you in your business, how
Correct.
transparent are you in business, will leads to a growth in the business.
Wonderful. Thank you, Arvinda, for this wonderful insights. I think it will really help every woman out here to actually touch base on, what they need to be knowing about tax investments, tax planning, and, thanks for clearing out our questions and the concepts. Finally, as we leave, if you can just give a line of advice to all the women, what they need to do, someone who's just starting off understanding tax for the first time, maybe this will be a little heavy, the topic, but what would you advise them to do?
Tax is not a monster as long as you are compliant to it. That's all.
Great. So thank you so much. And so here we are signing off, and we look forward to your questions. Arvinda is there with us on this group. You can put your questions here, or you can follow her on LinkedIn. You would like to share your ID or social, I mean, your logo, your ID, your social media ID, where they could have put on any questions if they require. Arvinda?
I will share it with you, not an issue.
Okay, so we can put it in the comments, or you can share your comments, and we look forward to your questions, look forward to helping you get financially smart, and to ensure that we all not just learn, do, and then go forward and teach. So thank you for being with us, and stay tuned for more sessions on Empower Her Future series, where we will be talking about various aspects of personal finance. Thank you so much.
Thank you everyone for your patience listening. Thank you.